Hey everyone! Welcome back to the channel. In this video, we're going to break down the process of financial consolidation in NetSuite Planning and Budgeting or NSPB, explaining why it's crucial for accurate financial reporting and how you can handle it with ease. So what is financial consolidation and why is it important? Financial consolidation is necessary to avoid overstating a company's financial position and results due to transactions between companies within the same corporate group. Now from the NSPB homepage we shall open the consolidation configuration screen. In this example, we are showing for budget scenario, but the similar process can be applied for actual scenario as well. In this screen we can view the shareholding percentage and the consolidation method for each consolidated subsidiary. We can select the required consolidation method from two types of methods, subsidiary and equity, as per the corporate's business needs. In general, for subsidiaries with a holding percentage less than 50% we use equity method, whereas for holding percentage above 50% we use subsidiary method. We can also view the shareholding percentage in a graphical representation below. Consolidation configuration is the first step to conduct financial consolidation. Once the shareholding percentages have been assigned for the subsidiaries and the consolidation method is set, we shall move on to the exchange rate screen to understand how the currency translation is working. The actual exchange rates of the currencies are derived from NetSuite through integration as seen in this screen, while the budget consolidated exchange rates can be adjusted manually by a user as required. We can view the exchange rates by selecting each subsidiary. Then we shall open the budget consolidated income statement screen and understand the financial consolidation process. In this screen we can view the chart of accounts for different subsidiaries. To understand the financial consolidation process, we will take an example of a sales figure where there is a transaction in the entity currency between two intercompany partners, and then the sales amount is converted to the reporting currency of the subsidiary as shown in the columns as USD_reporting. This amount is then nullified by its negative amount as seen in the elimination column. The consolidated amount then becomes zero for a transaction between two subsidiaries as seen in the consolidated column. Let's take another example, where we can see the raw material consumed by the India and the Mauritius subsidiaries given in the respective columns. The purchase is done in their local currencies, which is then converted to the reporting currency. After it has been converted to its reporting currency, the total amount in the reporting currency is then eliminated as seen in the previous example. As the company is selling goods to itself, we cannot show the profit made by intercompany transactions, and hence the transactions need to be consolidated. To show the consolidated amount in a single currency, all the intercompany transactions must be converted to its reporting currency. Finally, the total chart of accounts for each subsidiary in its reporting currency is consolidated, and the total PAT is shown. On top of the total PAT for each subsidiary, the holding percentage is multiplied and added to get the net profit attributable to owners. The difference between the total consolidated PAT and the net profit attributable to its owners gives the minority interest or MI. That is how we plan the financial consolidation process in NSPB. In short, financial consolidation is necessary for accurate and compliant consolidated financial reporting, avoiding inflated financial metrics, and presenting a true financial picture of the entire corporate group. If you find this video helpful, then please like and subscribe to our channel. For more information, reach out to us at support@EssProM.com. Thanks for watching.